Now, as tensions escalate between Iran, Israel and the United States, the global economic ripple effects are being felt far beyond the Middle East. To get a sense of what the geopolitical uncertainty means for South African markets, businesses and households, we speak to SABC Economics Editor Tshepo Mongoai. A very good afternoon to you, Tshepo. Thank you for joining us. We know that the oil price volatility linked to this conflict has pushed crude prices even higher, which typically has a ripple effect on fuel and transport costs. When it comes to the end user, the consumer here at home, what does it mean in terms of inflation and the cost of living?
Let me just summarize it through the last MPC statement that was made by the Reserve Bank, because they've made it very clear that when everyone else thought interest rates should have been reduced, because everything, mainly oil and rent, was stronger, inflation clearly was on a downward trajectory. You could tell that the bank was signaling that, they remain very cautious. And they also indicated and highlighted the geopolitical tension as one of the major concerns that they are keeping a very close eye on. They also mentioned the issues around administered prices, that, of course, there's still a lot of uncertainty around it and what could be the impact. So those factors were added into their model, and it pointed to the fact that they were a little bit, I would say, comfortable in terms of sustaining and their growth in achieving that 3% growth, 3% inflation target. But I must also indicate that, of course, the journey to that 3% inflation target might be challenging along the way. And of course, the escalation that we are seeing, it means that if they are sustained, they will have to change those models and revise them so that they are reflective of the current situation on the ground. But I must also indicate that the consumers have been shielded for quite some time from these high cost of living. Although you do still have other areas where you still have very stubborn prices like meat, particularly around services inflation. But generally, consumers have been protected. But going forward, things might be a little bit different.
We know, as you mentioned the word meat, I mean, we know that there is a bit of sensitivity around the agriculture space where, farmers are, now breathing a bit of a sigh of relief after those vaccines from Argentina, but consumers on the shop shelves are still feeling it in their pockets when it comes to the price of some meat. Let's then talk about the bigger ecosystem. What happens in a case where the higher fuel and fertilizer costs now are exacerbated by this latest conflict?
So usually the way inflation creeps into the economy is you would have an immediate impact through fuel. Usually the impact is very, very sudden. But you also have secondary effect that will creep in later on in the economy if they are not controlled. The Reserve Bank always talk about anchoring inflation expectations. That means that the so-called price setters, your unions, your analysts, they are influenced based on the target of the Reserve Bank to expect inflation to be at a certain level, so that when they make their demands, even government through procurement and so forth, when they adjust the prices for inflation, they are made to think about where inflation will be or is at the moment. So as a result, if their inflation expectations are at a certain level which is much lower, it means that the demands or even the adjustments when they do the contracts, the prices will be lower. And as a result, we won't have a runaway inflation, even if you are dealing with that inflation on the cold phase of higher oil price, a weaker currency or the rand. You would not have secondary effects that will make price generalized all over the economy, where you'd have runaway inflation that would be very difficult to control going forward.
And as you and I speak, I'm sure small business owners are monitoring and also trying to see what this would mean for them. With the price fuel hike just this week, we know that was not linked to the current conflict right now, which means potentially, I mean, you'll have to tell me what motorists can expect come April, given the impact of what we're seeing now. And also on top of that, I mean, you mentioned the Reserve Bank interest rates, keywords that jump out as a homeowner. One would want to know what it means then for your bond.
Again, I'll make reference to the Reserve Bank. They're saying that although we may have, they've got two scenarios. In fact, they've got what we call QPM, which is a model, a projection model that they use. And among the two scenarios that they've mapped out is the one that for quite some time we've been through, where oil was actually coming down and the rand was strengthening. And that would mean that it will actually be quicker to achieve that 3% target, 3% inflation target. Probably we would get there by 2027. There's also a neutral level that we could actually see much earlier this year or next year. But of course, the other scenario is when what we are going into now, possibly where the inflation is actually going up and the rand is weakening, and that will actually delay the Reserve Bank actually achieving that neutral level, but also achieving the 3% target. And it might be a bit of a struggle, but they've also maintained that despite the negative shocks that we are seeing in the economy, they don't expect that you might see inflation peaking outside their target, which is more of a volatile one, of around 4%. So they do maintain that they think inflation will remain well contained, although you might have temporary upward movement, possibly maybe above around 4%.
Very well. Thank you so much. Thanks for speaking to us there, bringing us up to speed. SABC News' Economics Editor Tshepo Mongoai.